You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, we're back with a special episode, and that's on the one big, beautiful bill. It is finally passed into law. It is all official. We'll be covering 100% bonus depreciation, QBI, qualified opportunity zones, and many other provisions and updates that we'll find in this bill. We'll be diving into all of that in just one moment. Breaking news, we just launched our brand new newsletter, REI Daily. After talking with clients and fellow real estate investors, one thing was clear. There wasn't a newsletter that delivered real market insights, concise decision-making info, and relevant tax strategy all in one place. So we created it. REI Daily delivers real estate news that won't put you to sleep, real and concise market insights that aid in your decision-making, legislative updates that actually impact your investments, and tax strategies sprinkled in because the IRS does not need a tip. If you're a real estate investor who wants to stay sharp without shifting through all of the clickbait or fluff, this is for you. And to celebrate the launch, you'll have a chance to win a free one-on-one tax strategy call with one of our top real estate experts. No pitch, just strategy. Subscribe now by visiting www.therealestatecpa.com/subscribe. Again, you can subscribe now by visiting www.therealestatecpa.com/subscribe. We'll see you in the inbox, but now right back to the show. All right, and we're back. Nate, thank you so much for joining us on the show here today. Big, beautiful bill. Finally got it done. I love him or hate him. One thing you guys say about Donald Trump, he knows how to close a deal. So what do we have to say about the big, beautiful bill here?
Yeah, Tom, thanks for having me on. Here's what I'll say to premise this, is that this bill, while it's one of the bigger bills that we've dealt with in a very long time, maybe like potentially, if you look at it from a deficit perspective, larger than 2017, and the Inflation Reduction Act, the deeper you dive into it, the more you realize that this is basically just an establishment of the status quo. It basically made everything that happened in 2017 permanent, right? It kind of made all the sweeping changes we had then and turned that into the current law. And saying that this is going to be the current law going forward, right? There's not going to be any more changes to it. There's not going to be very many sunsets. Now, there are new provisions for sure that we'll talk about today, but for the most part, this is just an establishment of what happened in 2017, saying this will be what's going forward in the future.
God, no, it makes a lot of sense. This isn't like the game-changing bill per se that 2017 brought about. This is more or less an extension and some add-ons to what was already existing. Why don't we start with what has been made permanent, and then we go into what's changed or what's new after that. So what has been made permanent in this bill?
Yeah, so if you get crazy and you said you want to read the text yourself, you'll see in the first part, there's basically a big old provision that says everything that's being made permanent, right? The major items that are being made permanent are the tax brackets, right? The 10, 12, 22, 24, 32, 35, 37%, right? Locked in. That's not changing. There's no sunset provision. That's the case going forward until someone decides to change that. Then the standard deduction, locked in, right? The doubling of that. The new standard deduction in 2025, I believe, will be 2026. Will be $31,500 for those who file married filing joint, right? So that's the new locked in. It's just the inflation adjusted rate. There's locking that piece in, but that's all locked in. QBI had some small tweaks, but it's essentially locked in. Did not go up to 23% like originally the House drafted. They had that, and the Senate pulled that out and brought it back down to 20%. So 20% is the official locked in number, right? Then the estate and gift tax. That's another one that's locked in and got a little bit of a bump, right? So 13 point something was the estate and gift tax exemption per spouse. And now it's actually getting bumped up to 15 million starting in 2026. So 2025, we're still playing with almost $14 million, but it's getting $1 million boost in 15 and is inflation indexed.
Cool. So a lot of good things being made permanent in their QBI for all of the business owners out there. That is a major win. There's been no updates there for specified trades or businesses or anything like that?
No. So, yeah, this is like where you get major differences and you got to pay close attention is that, hey, guess what? Like the House had a lot of things and a lot of changes they wanted to make. And the Senate ultimately yanked all of those out in favor of other items they wanted in the tax bill, which we'll get to, like bonus depreciation, but no carve-outs for SSTBs. The smallest tweak that I'll say that happened basically is that it's easier to get the 20% deduction now. So if you make $150,000 from your business, right, that's a taxable income threshold now. If you're at $100,000, you get the pure 20% deduction versus the $100,000 you had previously. So you got a $50K boost there. But that happened. And also, if you have basically a side hustle, if you make at least $1,000 of qualified business income in an activity, you get a $400 deduction versus the 20%, right? So actually you get a little bit of a boost there. But again, it's very small tweaks for QBI specifically.
Okay, nothing major here, I guess you could say.
Nothing crazy.
So you're saying that if you're above the threshold, you'll get a $400 deduction. Is that what I'm hearing?
Basically, yeah, you get a $400 deduction. That's exactly it.
Wow. Yeah. Exciting. Okay, that's kind of what stayed the same. I think a lot of that is good. A lot of good news in there. What has changed?
So one minor tweak that someone was asking me about earlier today is mortgage insurance premiums. Those are lumped into the mortgage interest calculation and are essentially deductible for that $750,000 limitation, because that's also permanent, right? So I know a lot of people are probably thinking about that. That's also permanent, but that insurance premiums gets lumped into the calculation now too. So just an FYI there. But what did change, right? SALT cap is one of the big items that got changed. So we'll touch on that briefly. Is that basically property taxes, state income taxes, anything of that nature, you bump that up to $40,000 now. So long as you make $500,000 or less. So that's one of the key caveats. And that only runs for 5 years. This is one of the few provisions that was not permanent. And it runs for 5 years. Once you get above $500,000, you slowly get phased out. Basically, it's like you lose a third of a deduction for every dollar you're over, essentially. So basically, by the time you get to $600,000, you get back to your 10K cap, and you're stuck at the 10K cap.
Okay, it's fair enough. That's fair enough. Make everybody happy, right?
Right. That was one of the gimmies that the Senate did not want to. They did not want to mess with it. They actually wanted to bring it all the way to zero. We're very upset with the House, but the House had enough power in the situation. They were able to get their win with the SALT cap. So that's what wound up happening there. Also, PTET deductions. I know that was a big deal. There were a lot of changes that happened initially in both the House and Senate bill. No adjustments, no touching of it. There's no changes to PTET. PTET still exists and an increased SALT cap. So I guess everybody wins at the end of the day.
Just for everybody who's listening may not be familiar with PTET, that's the ability for like a partnership basically to pay the state taxes on behalf of the partner and deduct it in the partnership, and therefore the partner's not actually deducting it. It's not included in the SALT cap. Is that correct?
Correct. It's actually, it winds up being a business, like your personal taxes, that basically wind up becoming a business deduction. And so it's actually really beneficial to do that. It's way better than having a 40K SALT cap. So now you can deduct both your property taxes and deduct your state income taxes at a business level at a favorable rate. So it's actually a massive win for business owners and high income earners.
That's cool. And on top of that, you have QBI. So it's a lot of interesting, good things going on there for business owners. We also have no tax on tips, no tax on Social Security, overtime. What's going on there?
Yeah, so no tax on tips. So this one's a little bit different provision. No tax on tips basically says you get a deduction up to $25,000 for people who work in a business that you customarily have been tipped in. So unfortunately, Tom and I can't start like changing our invoices to have basically a $10 like charge and then a required tip of whatever our advisory fees are, right? I wish we could do that, but they specifically have another clause that says anyone that's a SSTB, basically a service business, right? Like us, doctors, attorneys, we can't take advantage of this tip deduction, unfortunately. Also, $300,000 phase out beginning, right? So that's where the phase out begins if you're married filing joint. So honestly, Tom, I've been thinking more about this and I've been reading deeper into it. This helps a lot of people, right? This helps my hair girl, right? It helps her big time because she gets lots of tips because this got extended to the beauty industry. So it helps a lot of those people, a lot of bartenders, waiters, waitresses. It's going to really help those folks with this perspective. And then no tax on overtime. So this one, there's a little bit of ambiguity here at the moment. For both these provisions, the IRS has 90 days to release who this fits and the standards and how all this works ultimately, because the text has some ambiguity to it. But basically, it's like, hey, if you make up to your 40 hours and then you make 1.5 over that or 2x for everything above that, anything that differential is going to qualify for the no tax on overtime. Difference here is that no tax on tips is a straight $25,000 deduction, whether you're single or married filing joint. Different for no tax on overtime. If you're single, only $12,500 deduction, $25,000 deduction if you're married filing joint. So that is one key difference in this provision.
Got it. That's good. I know a lot of people wanted that. It seemed like it's in there in a roundabout way. We also have no tax on car loan interest. Let's talk about that. It seems a little interesting right there.
So this one, so I don't know if you've broken down the numbers. I've tried to break down some of the numbers. And right now, if you purchase a vehicle, has to be new. So it's a vehicle, right? It has to be for less than 14,000 pounds. It can be a motorcycle, it can be a minivan, it can be an SUV, right? A pickup truck, all those things qualify. Has to be new. Also, it has to be assembled in the United States. It does not have to be manufactured in the US. It does have to be assembled. That's the key difference here. So to qualify, you're going to have your VIN number. You're going to have a lot of different documentation that's going to be included. Probably going to be a new form because this is also an above the line deduction. This is not an itemized deduction. All the things we're talking about so far with no tax on tip, auto, no tax on overtime, these are technically above the line deductions. Some people might be like, oh, wait, that's like you have to look at adjusted gross income, whatever. So basically, you don't have to itemize take these deductions. Now, granted, there is a phase out with the auto loan interest at $150,000. After that, you get phased out every $200 for every $1,000 of income. So basically, there's a lot of people who might not get to take as much advantage. So like, let's say you have a 6.5% auto loan and you buy a brand new car this year, brand new motorcycle, whatever it is. You're likely going to hit maybe $4,000 to $5,000 of interest, right? Which, hey, that can wind up being $1,000 of tax savings. But if you start getting phased out and more expensive vehicles go down, like it gets it more difficult to truly get a massive deduction out of this, right? So if someone has like a 4 or 5% loan, there's a chance they have a really small, it could be like maybe $200 of tax savings potentially. So it might not be as usable as I initially thought it would be.
It seems like if you're a high income earner, you're pretty much this really doesn't help you at all.
It's not intended to help those folks. Absolutely.
Okay. Well, that's a bummer for a lot of people probably tuning into this. You're not going to be able to use that, but it was interesting. So 100% bonus depreciation is what everybody in the real estate world wanted to hear about. That's back permanently. But can we break that down, what this means, when it starts?
Absolutely. So I'll give it a quick 15-second history lesson on bonus depreciation. So bonus depreciation is a relatively young provision, right? It's only about 25-ish years old, so it's not super young, right? Just it's been a couple of years in its career. It's not a super young provision. It came out in like 2001 and started at 30%. And it's worked its way up, obviously, over time to where 2017 was 100%, and the longest it's ever been at 100%. So that was the longest stretch we had for 100% bonus depreciation, right? So we started at 30, got ourselves all the way to 100%, but previously 100% was normally just for a couple of years, limited provision, and always go back to 50%, something like that, right? And actually 2018, 40% was supposed to be what hit in 2018. So it seems like whenever we get to 40% bonus depreciation, it gets Congress a little incentivized to move. And so with that, we have now gone to 100% bonus depreciation being permanent. There's no sunset. There's no cliff that slowly drifts off like we've had the past couple of years. Basically, we have bonus depreciation in perpetuity until another Congress member goes and changes it, right? Until another Congress decides they need to also pay for some other deduction or something like that. But right now, we've got this in perpetuity.
Okay, that's great. 100% bonus depreciation does not look like it's going anywhere, at least for now, until someone else comes into office and tries to change it. But it looks like it's pretty safe for now. Let's talk about start dates and timing around this, because I know there's been a lot of questions. And now that the bill is finally officially here and passed, by the way, or if we didn't make that clear, this thing is passed into law, okay? This is now law. It's official. All right. When does it start? Like if I purchase a property in December 2024, does it qualify if I place it into service in February, or how does this work?
I wish it did, Tom. Unfortunately, it's a both placed in service and acquired requirement. So that means if you purchase December 3rd, 2024, you're locked in 60%, but unfortunately, you're not going to be able to utilize the 100% bonus depreciation because of that. Another quirk is if you've entered into a contract, right? So that means even if you haven't gone through closing, but you've signed most of the docs, now you have a contract that says, hey, I'm going to purchase the property, and then you close, let's say sometime in January, even though your contract was established in 2024, that means you're not going to be able to take bonus depreciation in this example.
Okay. So it's basically 2025 going forward after January 19th.
Basically, yeah.
Okay. Well, I mean, it's good news for everybody who's acquiring properties in 2025. Once, there's still 5.5 months left in this year, roughly. And still a lot of time to take advantage of it in 2025. And the good news is it ain't going anywhere. So it's going to be around for a while. So super exciting for all of our people out there, short-term rental owners, reps, lazy 1031ers. This all should be fantastic news. But I don't know, is anything else we have to talk about bonus depreciation before we move on?
Yeah, there are some things you can do with self-construction, right? Some people may have had some 2024 construction and like that's carried over into 2025 and still ongoing. There are some elections you can make, and you can kind of like call it components and somewhat split it up, take advantage of 2025 eligible assets. So just FYI there, it's a possibility if you're self-constructing. I'm not saying it's guaranteed, but there's a window that can be achieved to utilize that. Another thing I want to mention is kind of falls under the umbrella of bonus depreciation. It's qualified production property. It's a brand new provision that's kind of been carved out. And what that means is basically saying, hey, if you're a manufacturer, factory, et cetera, and you do manufacturing except in the food and beverage industry, you're going to be able to expense the 39-year portion of your property. And so I know we've talked about it a bajillion times on this podcast. 39-year property is one of the biggest parts that's not eligible for bonus depreciation, right? It's like totally what sucks out, doesn't suck out all of it, but basically it's why you can't write off your entire purchase price. With this new provision, if it's a manufacturing property, right, you can totally expense all of that. So if you have a big factory or something like that and you're a manufacturer and you purchase it or put it into service this year, you can take advantage of that 100% write-off.
With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Okay, and this is for factories. Am I reading this correctly that you can't lease it out? Like, meaning, for example, if I built a factory, and just using myself as an example, I'm not an operator, not a manufacturer, yada, 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 but I just construct this factory and I lease it out to JTB Industries and they manufacture whatever. I would not get the benefit of this. Is that accurate?
That's my current understanding of the bill. Now, there might be some regulations that expand upon that, but it looks to me that it's not meant to be syndicated out, right? Like, I know that was like something we wondered would be an opportunity for folks where syndicators purchase, have a factory, and then let a manufacturer come in and operate it. I don't think that's the case. And I don't think they want that. I don't think that's going to be the case here. There could be some caveats that the regulations provide, but as of right now, with the reading of the text, I don't think that's going to be possible.
Okay. That is still a very interesting incentive. Nonetheless, it's very clear they do want manufacturing. They do want production back in the United States. And it looks like that they are incentivizing that. So that's good to see. I know we have a few other things in here that are relevant. We have 179. We have qualified business stock QSBS. We have qualified opportunity zones and excess business losses. So maybe let's break some of this other stuff down. Because I know, there's people tuning in. I'm sure some people are wondering about some of this stuff.
Yeah, so one item that we've talked about previously was excess business losses. And there was a possibility that it was going to flip into basically where you would, basically the House had a provision, and it was in the Senate's initial drafts, where you would go to you would normally exit, right now, excess business losses, you're capped year one at around $620,000. And then you're stuck there, it's called an EBO. And then the next year, it converts into a net operating loss, has a lot more favorable treatment. And what the House and the Senate initially proposed was that these carryovers would stay excess business losses and would keep getting stuck under that $600K cap. So it'd be really, really difficult to utilize those losses, and you'd probably stack up a lot of losses if you're doing oil and gas or even short-term rentals over a long period of time against W-2 income. That's gone. That's not in the bill at all. I know that was like something that's been a point of confusion for a lot of people because it was in so many drafts. It's not going to be in there. So we've just locked in the current excess business loss rules.
Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode. Okay, cool. And just for everybody who's listening, maybe not familiar, maybe need a quick refresher, excess business losses, I think the number's around 628,000, give or take, for 2025, is the max amount of losses you can deduct against non-business income. This particularly impacts W-2 earners and people with large amounts of portfolio income, right? Because it's basically saying that if you had losses of $700,000, you're only going to be able to deduct 600, and I think 28,000 roughly is the number for 2025. And then the rest is going to get carried forward, right? Now, if you're a business owner, this doesn't matter. It does not matter. You'd be able to offset unlimited income with losses. Doesn't make a difference. But assuming you're in this category, W-2, high portfolio income, this EBL, this excess business loss, be carried forward to 2026, for example. And how the house originally had it written is that it would be actually stuck as an EBL. So if you had more EBLs next year, it would just kind of keep accumulating. But now it's a net operating loss, and net operating losses don't have that same restriction. Is that correct?
Correct.
This did seem very much like a loophole or an unintended consequence when this bill was originally written back in 2017. And I don't know if that was the case, an oversight or a loophole, whatever, but it looks like they're intentionally at this point leaving it the way it is.
That's exactly what I was about to say. So, like, they've blessed it at this point in time, it's been blessed. And so you can't say that it's a loophole or unintended. Same thing with PTET, right? PTET was an unintended consequence that was not meant to be in place. Both of those items, you can call them loopholes. They are technically loopholes, but they're just things that are locked into place now. And so, like, it's legislation and it's law.
Yeah, and that's pretty awesome because we had this one client, I don't know the timing of the episode is going to be released before this one or after this one, where that specific client, they had a $1.1 million NOL that they carried forward after wiping out over $280,000 of their taxes. So this was extremely powerful for someone like them. And this is good news overall.
Yeah, 100%. It really is. And then so qualified small business stock. There's a lot that needs to be dug into here. But basically, they just kind of, so in a random turn of events, because I did not anticipate any QSBS changes. I don't think anybody was expecting that to be happening. Honestly, there was an expectation that QSBS would be narrowed down, not expanded like it currently is. So now, qualified small business stock. Original rules, prior law, was basically, hey, if you hold a C Corp stock for 5 years and then you sell after that point in time, you can get up to a $10 million gain exclusion, right? So if you sell for $50 million and your basis was $40 million, that means that $10 million that you'd be taxed on, tax-free, right? That's $3 million back in your pocket that you'd have gotten taxed on. So fantastic, right? That's a massive win. Now, what they've done is they've increased that gain exclusion to be $15 million. They've indexed it for inflation. It was not previously indexed for inflation, which all these provisions are basically getting indexed for inflation, right? I know we've talked about this a couple of times on the podcast, is that we've got a lot of old provisions that aren't being, but these are all being tagged now. Maybe they see something coming that we don't, or maybe we all kind of assume what might happen going forward with inflation, but it's a big deal. There's also some holding period carve-outs that you can take advantage of. So there are old rules with QSBS. It's an older provision. It's been around since 93. And so they've had like some 50% exclusion, 75% exclusion of your gain. Now, what happens is if you hold the stock for 3 years and then you decide, hey, I want to sell it back to the company, I need capital, or I just want to get out of this, I think this is my exit point, right? If you do at that point in time, you get a 50% exclusion of your gain. So in that same example, instead of getting the entire 10 million excluded, you get 5 million excluded. And then if you hold for 4 years, you get a 75% exclusion. And then 5 years, you get up to the 100. So it just gives more exits for people. So no one feels locked into these types of deals, which is fantastic, in my opinion. It gives allows a lot more capital, allows a lot more investors to feel good about it, right? Maybe they hold for all the 5 years anyways, but it gives ability for off-ramps and still tax advantage ability to do so.
Cool. Another win for small business owners out there. So that's something that if you're a small business owner, you want to take a deeper look at. Before we move on from this, who would typically be someone who wants to take a look at QSBS? If I'm listening to this right now, how do I know if QBS is something I should even be considering or even caring about?
Totally. Great question. So not real estate, right? Unfortunately, not real estate. So basically, if you are not a service business, is kind of the way to think about it. If you're not a service business, right? So if you're not in healthcare, you're not in accounting, law, anything like that, it's at least worth taking a chance to look into, right? So like it's a very, very narrow scope of business who it applies to. But as long as you are not those things, you are not the things I just mentioned, you're not a consultant or something like that, and you've got a business, it might be worth looking into and seeing what a C Corp election could do for you, assuming you want to sell in the next 5 to 10 years, sell your business in the next 5 to 10 years. It's at least worthwhile to look into.
All right. So business owners who meet those criteria, go take a look into that. We got a few more things here. I think one of the most relevant ones we have left here, probably the qualified opportunity zone rules. Do we want to break that down?
Yeah, let's break that down. So I was kind of hoping for a really big expansion for QOZs. Don't get me wrong. There's still some good stuff in this bill. I was really hoping that we would see some really large changes. Like I was hoping in the 2026 deferral, right? Right now, 2026 is a recognized event for the original QOZ investors. And so, unfortunately, 2026 is still the date that you're going to have to recognize capital gains and then pay the tax in 2027. So no escape from that, which I was hoping would happen. Now, the new QOZ rules start January 1st, 2027. And so basically, what's going to happen, we've got a little bit of a blackout period, unfortunately, for QOZs. And so everyone's going to, like all the QOZ funds, QOFs, are going to have to hold their cash, and then they'll be able to start allowing these investments to happen to Q. And so what's happening now, QOZs are permanent, and they're rolling 10-year tranches, essentially, right? So there'll be a new period every decade someone can invest into. So right now, the first one is going to start 2027 and then 2037. And then after that, right, that's kind of the current designation of it. There's going to be new designations the state can make every single year. Demographics change, whatnot. Hopefully, if QOZ is a success, that means that area is no longer a lower income type area, which is what the intention of this is supposed to happen. And hopefully it's increased that and it's gone well. It's provided a lot of jobs, opportunities for folks. So now they can have new tranches and new areas that they can invest in. Also, if you hold for 5 years, you get a 10% step up in basis. That is also the time that you are forced to recognize your gain deferral. So basically, every 5 years, if you have capital gain investment that you want to do and you wanted to kick that down the road, if you start at the beginning of the program, you got 5 years. So you got 5 years, you can kick that thing down the road. You get a 10% step up in basis. I think I just mentioned that. If you invest in a rural QOZ, there's a little bit different rules and specifications, but if you get a 30% step up, they're really trying to push rural investment in this one because so right now it's like you have to have a 100% increase to your basis if you want to improve a QOZ. Now it's a 50% if you're in the rural, right? So there's another change that's occurred here that's made it a little bit better. Also, the other thing to think about, so right now the 10-year hold is still in existence and still makes sense, right? So the 10-year hold still happens. However, if you decide this is a great investment, I want to hold that. Let's say you hold till 30 years. That is now your forced election date, right? Right now, you can make the election at 10 years. You don't have to, but you can make the election at 10 years. You're required to make it at 30. So basically, if you somehow get into an amazing QOZ fund, you want to keep holding and you keep holding, at 30 years, you're forced to make your step up at that point in time. So you can't just hold in perpetuity and then decide to make your election. There is like a forced date.
Got it. So that's basically they're saying at some point you have to say, this is the date where I'm locking in my cost basis, for lack of a better way, maybe
essentially, yeah.
And saying then if I sold after that I'm going to have to pay tax on the amount. So I mean, it's still very powerful. I mean, I'd say overall, these are, you mentioned not to the extent that you wanted to see, but I mean, these are still pretty favorable overall, kind of making this permanent, allowing people to have that 5-year step up if they hold, making that having to be the election period where they have to pay. That kind of makes sense. And then they're still able to hold for 10 years or more, get that exemption. And then, of course, if you're still holding on to this thing after 30 years, if you have to make that election, I think that's a fair enough rule to put in there. We don't want people getting too rich off of this, right? I mean, but anything else we need to know about QOZs?
No, I think that's a pretty good summary of it for now until we get more regulations. A lot more reporting requirements will come from the IRS, but as of right now, that's pretty much the gist of it.
All right, cool. So I know there's maybe one or two more things in here that maybe make sense to hit on, and then we can wrap this one up. We have the expansion of 179 and then interest expensing. Let's just go with 179.
Yeah, so 179. So look, this is my theory overall. Congress eventually wants to move to where if you buy an asset, you get to expense it right off against your income, right? If you're a business or if you're a real estate investor, right? We're starting that with the new qualified production property and by implementing 100% bonus depreciation. And then on top of that, we're also increasing the 179 threshold, right? So which 179 way back in the day was a $2,000 deduction. Now you can expense up to $2.5 million of 179, right? They also favorably increase the phase out limitation. And how do these work basically? So with 179, it's a election you elect into, while bonus depreciation you must elect out of. So those are the two differences in my opinion for these. And so what happens here is essentially you can choose to elect asset by asset into 179 up to $2.5 million. You're capped at that number. Now, if you have, let's say you purchase a gas station and that's all eligible for 179, but it's a $5 million cost basis, essentially, that would mean you're not eligible to take any more because you're $1 million over the 179 cap, right? That got pushed to $4 million, but still really favorable. There's a lot of advantages that a lot of commercial and even short-term rental investors can take advantage of here.
Okay, that's good. That's good. Okay, so if I'm tuning into this right now, because I know there's a lot of confusion always around 179 amongst questions that I get from clients and what have you, who does 179 apply to?
Yeah, it's a great question, Tom. 179 only applies to commercial property, right? And so basically, what is commercial property? Commercial property is anything that's not residential. So right now, residential gets somewhat favorable treatment because they don't get depreciated over 39 years. They get 27 and a half. So they say you're not eligible for 179 deductions. 179 deductions are only for commercials, so like hotels, commercial shopping squares, things of that nature, right? If it's a business type property, then it's going to qualify and be eligible for 179. So I mentioned hotels specifically because short-term rentals can fall into that bucket, just FYI. And that can be a big advantage, right? Now we have 100% bonus depreciation, so maybe we don't need 179 as often, but 179, we're allowed to expense HVACs. We're allowed to expense roofs, right? We're allowed to expense these large systems that we normally wouldn't be able to via 179. So it's a great combo to do mostly bonus and then have 179 on top of that, in my opinion.
Okay, cool. No, thank you for clarifying that. Just want to make sure everybody's clear out there on how what 100% bonus depreciation is for and 179. We have interest expensing, right? Interest expensing, and I know that impacts a lot of syndicates and funds. Why don't we touch on that? And then if there's anything else we need to touch on in this bill, we could do that. If not, we could just summarize it, wrap it all up.
Totally. Yeah, Tom. So interest expensing essentially has just kind of been modified. So what we had previously was there's a 30% threshold you have to do when it comes to syndications and funds when it looks at your overall interest expense on your property. And what it does is it looks at your EBIT, it looks at your taxable income, and then applies a 30% number to it and says, okay, great. Let's say you make $1 million, you have $300,000 of interest, and you have $300,000 of interest expense. Guess what? You get to deduct all of that. If you had $400,000 and $1 million of tax, of what we call adjusted taxable income, now you only get to deduct $300,000. You had $400,000. You only get to deduct $300,000. That $100,000 is a carryover into next year. Thankfully, they adjusted this because previously we've had to get to this ATI number, we've had to deduct depreciation and amortization, which in real estate is a big deal, right? Because if you're doing cost segregation studies every single year or doing lots of improvements and renovations, it's going to really drive down your taxable income number and limit your interest.
Right.
Now, we've gone back to old rules where you don't add in depreciation and amortization, made this permanent. So now you're looking at EBIT calculations, not EBITDA calculations when applying this 30% test to deduct interest expense.
Cool. So it works out great for a lot of syndicators, fund owners out there who are subject to this. It's good to know. Anything else in this bill that real estate investors, business owners, personal individuals in general would need to know about?
Yeah, Tom. So there's one provision. It's like when it comes to itemized deductions, right? So there's a new charitable deduction cap, basically. And so effectively going forward, itemized deductions are going to be capped at 35%. And so what that essentially means is that if you are in the 37% bracket, let's say you have $1 million of charitable deductions, you're going to get to deduct $350,000, not $370,000. You're not going to get to take advantage of, get a benefit from that $1 million contribution, right? You're going to have a $20,000 difference in there, right? That goes into effect in 2026, not 2025, but new rules and new things to think about when it comes to this piece. There's a little bit of a change there.
Got it. So Basically, what I'm hearing is that you might be capped on the amount of charitable deductions and itemized deductions overall that you could take.
You got it.
Got it. Okay, cool. So that's something else for people to plan for. All right. So to summarize everything here, Nate, I think you said it best as we kind of entered this episode. Not a huge sweeping bill that changes the game per se, but more or less things that were made permanent, extended, and slight tweaks overall. I think the most notable one, obviously, for everybody tuning in is 100% bonus depreciation. Everybody loves that. But there's other things in here, QBI, qualified opportunity zones, the permanency of the current tax brackets, standard deductions, and some of these other things here we discussed within this episode. I think it was favorable to taxpayers overall, I would say.
Totally agree.
So look, there's 5.5 months left in the year. And that means for everybody who's out there, if you're considering short-term rentals, considering the real estate professional status, trying to make a lazy 1031 exchange happen, and that's when you sell property, buy another one, do a cost seg, take 100% bonus to offset the gain. All of that's still very much in play. I know I've personally seen people execute strategies like this with a lot less time, but the faster you could make a decision on to move forward with something like this and then execute it, usually the better. The more options you have and the better outcomes you'll achieve. So this is a big win. It's official. This bill is now into law. So for all the real estate investors out there, now's the time to hit go. If you've been on the fence or you've been on the sidelines, we'd love to learn more about your situation, see how we can help. You could request a free discovery call by following the link in the show notes. Nate, anything before we wrap this one up?
Tom, I think you broke it down really great. So I noticed that some of you may have been following my newsletter and you're like, oh, what's going to happen now? I'm going to be breaking down strategies that investors can make and utilize going forward, right? So don't unsubscribe, don't unclick and be like, all right, tax updates are done. I don't need to listen to Nate any longer. Totally continue to listen. I'm going to be putting in strategies and going in depth on how we can take advantage of the new strategies the bill's given us.
Right. So yeah, it's not just understanding what changes are in the bill. Obviously, it's understanding how those changes impact your situation. What strategies can you put together? How can you piece together the puzzle to best maximize this tax bill? So stay tuned to Nate's newsletter, stay tuned to the podcast. And if you do want someone to guide you through exactly what you need to do one-on-one to take advantage of this bill and everything else that's available to you within the tax code, again, click the link in the show notes below. We'd love to learn more about your situation and how you could help. You do not need to navigate this alone. ChatGPT can get you a long way, but it's not going to get you everywhere. We've proven that time and time again now, and you really want someone in your corner. So that's all we got for today. Thanks again for tuning in, and we'll catch you on next week's episode of the Tax Smart REI Podcast.